I sold Nvidia way too early and I gave interviews about it. And next thing you know, it's on the news like every couple months. I made like 100% profit on it, sold it for no reason. Big mistake. Why do we sell future winners? We misestimate the value of sell decisions. We always think it's in the buy. It's fascinating because we can identify and pinpoint what the biases are that are driving underperformance. Hey, Molly, it's my pleasure. I am so pumped to be in front of these amazing minds, all excited about the same topics. I think we all have a lot of questions on our minds. So why don't I just kick off with a question? This is the classic starter. This is what we kind of call the cold open, in the biz. I'll share my screen and let's kick right off with a cold open here. So I see there's an age range here. So I'm not the old guy in the room, which is nice. So do you remember what happened to this particular shuttle on Saturday, February 1st, 2003, loss of human life, about 8 people died. And it's like one of the big engineering mistakes that NASA is sort of known for. So let's start with this sort of hard story and transition to another one that some of us might know also. And I want to know, well, what happened? So the why part, as I mentioned, seems to be about this foam component that broke off, but let's look at actually what led to that. Before we do that, let's look at another one. So long-term capital management. This was a very famous firm. So some of you already know about this disaster. I think every CIO dreads to ever end up in the story like LTCM. But on September 23rd, 1998, something very bad happened. Anybody remember what happened for long-term capital management? What's that?
Russia defaulted on the bonds.
Yeah, the ruble went down, and the default happened, was not in the models. And from a performance standpoint, we have a big plummet and a lot of systemic problems, bailouts. Like this is like generational kind of bad stuff. So the reason I start with the
question in those days was what's the difference between a ruble and a dollar? A dollar.
Oh, that is a good one. I'm going to use that if I may. I'm going to use that joke. That's really good. Yeah. That was not in the models. I don't think these guys were appreciating what was going on at that time during that really eventful time. So the why part is potentially very similar to NASA. So I want to dive into some of the similarities between these two things. So the common factors between the Columbia disaster and long-term capital management was groupthink. So we're dealing here with management, we're dealing with leadership, Euro leaders, and one of probably the most common biases we hear about is groupthink, the idea that people all kind of form this homogenous view and don't have dissenting views. So we saw it happen both in NASA and long-term capital management. It gets even harder when you're all trained similarly. So these Nobel Prize winners, I have the same training. My PhD is in financial economics and neuroeconomics. And when I get in a room with other people with that training, we think very similarly, and it's very difficult to have these radically different perspectives. And so when I was being taught about this in my PhD program, I was just like nodding because you're not allowed to speak against the orthodoxy. The other one is confirmation bias. This is one we've probably also heard about, that if you have a pre-existing idea, it's really difficult to shake that idea. And whatever you see will support that original idea, even if it's not confirming of that idea. Like ambiguous information will not be seen as ambiguous, and even conflicting information will just be seen as a mistake. And there's a lot of research on confirmation bias, really tough to combat. And so again, a parallel between NASA and long-term capital management, where both leaders interpreted these movements as like, oh, this is not an indication that we're wrong, just confirming that we're right. The other one that you may or may not have heard of a ton is normalization of deviance. And the way that NASA saw the foam shedding, they're like, well, it's an acceptable risk, it's not a big deal. Same thing. LTCM saw these like correlated bets basically being like normalized and unchallenged. This is okay. It really is not risky, but the deviance was actually a signal that was ignored. Moving on, the classic one is overconfidence. So overestimating the risks and overestimating your particular ability to understand data. That's a classic trait both in NASA and long-term capital management. One of the things when I dug deeper into the catastrophe, they only use 5 years of data. So if you're only using 5 years of data, it's very unlikely you're going to have extreme events. And if your distribution, which is not normal anyway, is missing extreme events, then it's simply wrong. And so that I was shocked they only using this short data set. So another classic one. And continuing on, we have the sunk cost fallacy. We all struggle with this one. We've already invested this effort. We've already invested this time. I don't want to do something that makes that investment not valuable anymore, perceived to be not valuable anymore. And the same thing across both sides. One of the things we'll talk about here in terms of individual biases is this doubling down on losing positions. So you could be a dip buyer or you're a loss chaser, and it's important to know which one you are. We'll get into that later. And authority bias, this is classic, and it's critical for a group of leaders like we have on this call, is are you having your junior people, if you have a real kind of linear hierarchy or a vertical hierarchy, are junior people allowed to speak up? Are they listened to? And the same thing really happened on both sides. It led to the catastrophes. So I wanted to go into some of these like really clear parallels of something that's seemingly unrelated to finance and compare it with finance. So we'll come back around at the end, but that's, I think, a really interesting way to start this. So given that setup, I usually give this talk to individual investors, financial advisors, portfolio managers. This is really catered for you specifically as CIOs. And so I typically ask the question, what determines your portfolio performance? And so I've listed some of the factors that an individual PM might be thinking about. So the asset, firm performance, asset weighting, all that stuff. But I wanted to focus on you specifically as a leader who's leading a team. So I have a list of ideas that we'll go through some of them, but before I just click on it, I want to know, what do you think determines your team's performance aside from like asset specific things and fees and slippage and all of that? I'd like to hear some ideas before I kick it in.
So I'm in the wealth management space,
Cool.
and for me, it's taxes. And the reason is, first of all, in high income individuals have high tax rates, particularly in high tax states. The second reason is that's the issue. That's the factor that is typically ignored. Everybody talks about pre-tax performance. Actually, in the individual space, makes no goddamn difference. It's the after-tax performance that counts.
Yeah, absolutely. Yeah. We're doing an analysis for a PM out of New York City, and the same thing. We're looking at the delta between tax loss harvesting and not tax loss harvested, and it's pretty significant. So I actually agree. From a leadership perspective, you managing the people making the decisions, what are some of the other factors? So if somebody's responsible for the tax loss harvesting aspect of the portfolio, how can you empower them to make good decisions? That's really where I'm trying to go with this, in terms of from a leadership perspective, the people kind of doing the work.
Yeah, sorry. I was going to just say psychology, and behavior. It's all well and good having all of these things, but if you don't have the right emotional guardrails and the right emotional discipline in place, then you may override a lot of the rules that you've already got set, if you have any rules at all. So emotional discipline and psychology, depending on the market conditions, is one of the most important determinants of portfolio performance, at least in the personal portfolio perspective, but it obviously also translates to large portfolios as well.
Yeah, so I would say two things. As the leader, how you frame the objective for the group, and then secondly, how good of a listener you are, and that connects really to the communication process. Communication really is the key to teams working well. Yeah,
active listening, communication, absolutely. Yeah, let's get a few more in there before we keep going, please.
Khalid?
I attended a conference of an nuclear submarine commander, an admiral of I can't remember which fleet, and his view of the team work and extracting best value of the team was very interesting, and it was how to make sure your team is autonomous in the worst case scenario, and not necessarily rely on the chain of command to adjust and manage in order to perform well. That resonated with me a lot.
Autonomy in crisis. I love that. Yeah, that's great. What else?
Go ahead, David.
I would just say managing conflict and confrontation. on a consistent basis to get to the best answer that maybe people have a hard time being wrong and managing that effectively as well.
Mm-hmm. Managing and resolving. The unresolved stuff will show up later, so it's better to like manage and resolve, truly resolve, because you see it pop up later through like all sorts of petty behaviors and things like that. So that's a great one. I know there's lots of hands. I've got like unfortunately 56 more slides. Can we do one more? Let's I'll keep going. These are great. Right? We could spend the whole session on just this one slide.
Yeah.
Yes, I think philosophy and our investment framework, what determines our performance, our philosophy. Thank you.
Awesome. Cool. Okay, these are amazing. By the way, I always knew there's a slide you could spend the whole session on. Let's keep going. Some of these themes will certainly populate through the rest of this. So we've talked about internal processes like in chaos. Are people autonomous? Feedback and evidence. That's one of the key parts that's really been like missing from specifically discretionary and more qualitative sort of management, where there's not really good data, not great feedback that's regular. Like we talk about these disasters, like there's not enough feedback towards the decision process. So data and insights are important, but being able to see them objectively is one of the behavioral challenges, which was dismissed in both of those mishaps. Training and tools, ongoing training, new tools. We'll talk about some AI tools that are out there that certainly we've developed at Profit Wall Street. Aligned incentives. I'm surprised maybe somebody was going to mention this word, but the big I word, certainly in economics, is are incentives aligned? And I've seen this. I worked at a hedge fund for 2 years, and when you see the back office incentives misaligned with the front office, middle office, like the whole process doesn't work as smoothly as it should. The group dynamics that have been mentioned here, certainly critical. Resolving conflict, making sure there's high trust environments, critical. As I mentioned there, transparency is also important. If you're spending finite cognitive resources trying to figure out what's going on around you, then it's hard to function. And then, as I mentioned, a functional hierarchy. So I love what you had said earlier about the nuclear sub commander who said, when things hit the fan, do people have autonomy, or are they like waiting for the chain of command to tell them what to do? That's not a good situation, certainly in crisis or even in a quotidian situation. Adaptability is critical. If we're like one-trick ponies, we're great at shorting, we're great at one thing. That's not going to be enough. And thank you for the comment about taxes. Like we're getting more and more questions about taxes and building tech that helps people deliver better tax smart strategies. So there's lots of these kind of non-quant things that are kind of in the soft space. And what we're trying to do here is provide a framework to take quant information and help people in the soft management space do a better job to help people improve their performance over time as a leader and for the individuals that work under them. I have one slide on behavioral finance, even though it's this huge space. I'll go through it sort of quickly because it's its own field with like a bunch of Nobel Prize winners in it. So there's kind of 4 big branches of behavioral finance. So one of them is investor and fund manager biases. So that's one that I've certainly spent a lot of time in. My dissertation, which we'll talk about in a second, I looked at where is it that people completely misestimate? Where is it that people go wrong? I think that's a lot of the focus in this area. My interest is how do we fix it and where do people go right? Because you can't just be nitpicking on people all the time. Market efficiency. So this is Eugene Fama, the efficient market hypothesis. We've all been exposed to that quite a bit. It's interesting. Fama got the prize the same year as Robert Shiller. I think it was 2016, who disagrees with efficient markets. And so they won it the same year, which is really great. Experimental finance is an area that very few people outside of academia have heard of. And essentially, it's the same idea as any other experimental space where we're testing theory in a controlled, simplified environment to know if you modulate one variable, how does it affect like bubbles or crashes or bid-ask spreads or whatever it is. And I tested a theory in that framework. Nobel Prize was given for that 2002, same year as Tversky and Kahneman. And then the final piece is decision neuroscience, which is, you might be thinking, what does neuroscience have to do with finance? Well, if we know how the brain works and we know how we compute things, how we calculate things, and what our brain is actually optimized for, then we're actually better off in designing decision environments to help people make the right decisions. So behavioral finance is a huge space, and I find it absolutely fascinating. That's why I work in it. Neuroeconomics is a branch of decision neuroscience, and we're going to cover about 4 billion years in maybe 30 seconds. We talk about the biological roots of behavioral finance, which is that essentially as humans, we were we've evolved in different spaces, and now we live in this world. We're having a Zoom conversation. There are people here from across the planet, and thank you for staying up late. We're all together using technology, but the way that we've evolved from being tribal and highly exclusionary to where we are today, like we look at a lot of the realities we have, they're based on sort of atavistic factors. Technology has actually made things a lot worse in some ways. By accelerating decisions that are difficult to make, we make worse decisions. We'll talk about that later on the Fintech section. And some of the biases that we'll go through in this talk, they make sense from that perspective. So if you look at the whole evolution of our species or even of society, like it shouldn't be a surprise that we struggle in some of these ways. But understanding the biology is helpful. And one of the reasons, the key thing, I'll distill like thousands of neuroscience papers into just one graph, that we have a common currency part of the brain. And so we're making computations, we're making decisions. Our brain is looking at like good things in sort of a general sense. We don't have parts of the brain that calculate money separately from like other good things like food or whatever. We have this like sort of rough simplification of this thing a good thing. Am I happy with it? Am I scared of it? And so if we understand how the brain works, then we're able to facilitate better decisions. And that's really what I do. So I leverage my background in behavioral finance, behavioral economics, neuroscience to help people, whether it's a CIO or a PM or an emerging manager, to make better investment decisions. So that's what really my focus is. And I'll very quickly show you my dissertation, which was absolutely wild. I wondered, well, what if we increase testosterone among young males? Would they trade stocks differently than similar males at their like baseline placebo levels, like their baseline unaltered levels? So we did a randomized controlled trial. Yes, we got ethics for this. We took blood samples. We used the drug that is prescribed by doctors, and we tested if we give the drug, will it change trading behavior? So what you're seeing there is a graph of the price difference over the fundamental value. And when these guys are trading, they know the fundamental value, which makes these experiments much more clean. So here's what happens when you add testosterone to healthy young males. You get these huge bubbles and crashes. So those are 3 trading sessions you're seeing, and it's like off the charts wild. We've never seen anything like this. So this was the first evidence in human history that you can change a specific biological variable and immediately change people's behavior. It's absolutely wild. So I was very excited to get that result. It kind of launched my academic career, and now I get to talk about these cool studies and build tech around it. So that's kind of the cold open for this talk. And Molly, thank you for the intro again. My name is Amos Nadler. I'm the founder of Profit Wall Street. My background isn't just academic. I was an academic for about 10 years at Claremont. I got my PhD there and worked at the Center for Neuroeconomic Studies. We did a lot of crazy work with like DARPA and like defense industry to figure out how people make decisions. It was absolutely insane. Can't talk about most of it. But then I was a professor for a while, and I realized that research is great, but it doesn't make its way to the public. Interfacing with CIOs was almost non-existent, and I got sort of frustrated. So I went into the private industry. So I have some war stories that you guys would probably laugh at if I was to share in terms of what actually happens when decisions are being made. Then I worked at a hedge fund, a quant fund for a while that I helped start, and then launched Profit Wall Street more recently to really develop this technology and deliver it in a scalable way. So the talk today is the Optimized CIO. How do we leverage behavioral fintech and behavioral economics in general to outperform? So the main 3 buckets, and Molly, thank you for the guidance on what areas would be helpful, is how do we identify and how do we quantify behavioral biases? The other aspect is how do we build a bias-resistant institutional process? Otherwise, we're just going to be kind of like everybody else and operating from default. And then we're looking at human tech synergy. How can we work together with machines versus just thinking about them taking off the full load? Together actually we're quite amazing. So that's a plan for the day. Any questions so far? I know I'm talking a bit fast because I kind of put a lot of content together, but any questions? And again, feel free to interrupt me. So I'll just pause for a sec before I launch in the next part. Who knows about the Buffett bet? I'd love to know who knows the story and how it ended up. Looking at any hands there, Molly, on who knows what the Buffett was? Buffett bet a while back?
Buffett won. Yeah, he bet a bunch of hedge fund managers whether they could outperform him, and he lost. Well, passive fund rather.
Yeah, can you beat a passive benchmark year over year, right? Yeah, that's basically it. $1 million, beat this for a decade, and surprisingly, not a lot of people took him up on the offer. Like you would expect lots of people to take him up, but I think the sticking your neck out part and being humiliated, I think didn't appeal to people. But he did this to demonstrate a point. that active management is tough to do consistently. Sure, you can have one outperforming year too, but to do it year over year is a challenge, and he just had the simple way of showing that. So let's talk a bit about active management. I know it's not everything, and certainly asset selection and asset weighting are critical parts of building a portfolio. We know that, and if we have time, we'll talk about that. But let's dive into active management. So the data on it isn't great. You know, the New York Times likes to skewer that mutual funds don't outperform their sort of relevant benchmarks, and there's lots of research on this we'll go through now. So the way that I got interested initially in behavioral finance was looking at specific papers on the biases of individual investors, so whether portfolio managers or high net worth or whatever. And I was sort of shocked. And I don't know if you guys dive into the Journal of Finance or the American Economic Review. I know these papers are like 1 million pages long and relatively dry, but you like dig into it, it's fascinating because we can identify and pinpoint what the biases are that are driving underperformance. And when I was a graduate student, I read one of these papers. It's actually that first one. Actually, right below there, are investors reluctant to realize their losses? And I thought, wow, this is really cool. People sell winners way too soon, and they don't realize the losing positions, and so they're going to be underperforming what they could be doing with some small changes. My first question was, why is this not built in my trading platform? This was like over 10 years ago. And so that's really what I've built, are modules that read your data and show you what specific biases you have and how much they're costing you. And so that was like the first build that we did at Profit Wall Street. But I was sort of frustrated that no one's taking research and building something that's useful for people to do better. So the research shows us it's out there. The next part is active management tends to outperform. Like in overall, I think this is the Morningstar study, came out, this is from 2023, and the data is the same for 04 and probably for 05, is that the difference between passive and active tends to be in favor of passive. But we still have all these active funds. I don't think that it has to be this way. And I think that deploying behavioral technology can actually make a very big difference and start to move these numbers around. So where do we go wrong? This is a pause. I want to know where you think where active management goes wrong. What happens?
You're active. You have the option to make a decision and change your portfolio, which can really, really, wreck your portfolio or harm your performance, for that matter, over a long period of time.
So you're saying just the ability to be active is a liability. Is that kind of a fair?
Yeah.
Okay. So if your hands aren't tied, you're potentially in trouble.
In general, I think you can beat them out for a certain period of time, and I think that skill set wanes because the environment around you, the market, digitalization of the market back in the early 2000s was a big factor. I'm just saying, as an example, things change, and our ability to always adapt consistently is one cause why we can't over time actually, I can say right now, hey, let's all start up hedge funds or mutual funds this year. Good half of us will outbeat it because we have an inherent good ability to pick stocks. But over the next 5 years, how many of us who outperform this year will do it in 5 years? And I think that's just the nature of us, the ability to adapt, the market around us changing, informational advantages change as well. So there's many factors, but I just think that the answer is, what period of time and consistently and so forth.
Zaid, let's come to you, my friend.
Sure. On any given day, when you have equities, treasury, and US dollars selling, and you have given access to your clients to trade, they tend to overtrade. We spoke about Buffett. He talks about get greedy when other people are fearful, and get fearful when other people are greedy. What happened on April 8 when the VIX hit 52 and the S&P was at 48.35? Why didn't people get in there and buy? I think a lot of that happened because instant gratification goes the other way, where people want to get in and out real quickly. And a lot of that happens to do with gamification that El just spoke about, but giving access to people and letting them play with money and not letting them sit back. You can talk about cognitive dissonance over here. You can talk about prospect theory. There's so much that comes into play from behavioral finance.
Apart from suboptimal decision making, I think also active funds tend to be more expensive than passive funds, and the potential return gain does not outweigh those additional costs.
Sure. Yeah. I think that earlier slide, I think it showed a gross of fees. I think it wasn't even net of fees. I think just pure performance didn't do, but absolutely eats it away. Yeah, but your point is well taken. People pay for active management and don't get the return for it. So as was said, so these biases, so the way I've been using this word bias a bunch. So let's talk about what that means. So it's basically an irrational belief, assumption, reactions, like the things that make it difficult for us to make evidence-based decisions consistently. So I know that's a broad definition, but let's get into it. So a bias is, it's some distortion. So there's many biases. And if you look at the list, there's like over 3 dozen. So the examples that we'll go through these are ones that I've chosen them because they are cleanly identifiable in data generally, and they can be fixed and they make a big difference. Like some of these are very difficult to figure out, like pick one out of the air, like representativeness is a bit more vague. I don't feel as confident picking that one out of raw data as I do, for example, loss chasing or the disposition effect, which we've built algorithms that can measure it. So biases are what make it difficult for us in lots of different ways to make these evidence-based decisions. So my question to you is, well, this information is public information. Like you could go to Google Scholar, you could attend, you could get a master's or PhD, you could read books. So far, I haven't told you anything that you don't know. And I'm curious, why do you think people don't just like fix the bias? Like what's going on? Like you read about the disposition effect, that you sell winners too soon, you don't sell your losers. Like, why don't they just fix it?
Incentives.
You think incentives?
This is a really great area, and I have no clue what I'm talking about here. I'm just giving you what comes from my gut. But I read something, and I think a lot of us, when we think about our own personal development, the environment we grew up in, and so forth, a lot of us will have to be really honest with ourselves to say basically that physical addictions, there's mental health addictions. And what I mean by that is that if you're a person who's prone to anger, there's an intoxication from getting angry, right? And there's this notion that, hey, it's just easier for me to react in anger because that's the way I was raised or whatever. And there's an intoxication. It's a much harder behavioral correction to change and manage your anger if you have an anger management problem, as an example. And I think in some ways, just like AA and other things, people don't change their biases because it's really hard to do that. And if the easier way out is to just be acknowledging it and then try to curb it, there's a difference between solving the problem versus treating the problem, right? Treating doesn't necessarily eliminate the problem or the challenge. Solving it is what really gets is the issue. But there's a lot of times, and this happens in stocks and companies, where you invest in a company and they say they're trying to solve for something when they got a product or service that only treats the issue. Right. And the same thing with us is that we don't change our biases or change some behavioral patterns because one, it's just simply hard, and we don't recognize it at times either. And I'm just being pretty naive and simple in my answer. I'm just saying that's where I think neuroscience and behavioral finance and other things comes into play, because we can sit here and say, hey, we made an objective decision on an investment, but inherently, if you look back and you think about it 3 weeks later, some of the things you're thinking may not apply. And we, as one thing to eliminate it for us, which I don't know if it's foolproof, is that whenever we go out and look at a manager, spend a day visiting with a bunch of managers, have all our copious notes and everything, you get this emotional high. It's kind of like going to a concert and you come back. We drop the pencils. We don't talk about it as a team for a week until we get all that emotional construct out of our system. And then we'll revisit it. We'll look at our notes with a much hopefully less biased view.
Yeah.
But I think it's just hard.
Yeah, it is hard, but you tapped into something important, which is like a medical model of the idea of diagnosis and treatment. And that's exactly, I actually wasn't planning to use that language, but that's exactly what's behind what we do is, and I'll show you that we can diagnose it and we can treat the problem. And I don't mention this in my CV, but I worked for a maxillofacial surgeon when I was an undergraduate, and I was like shoulder to shoulder with the guy, like he was like training me to be a physician. I'm a big disappointment, became an economist, but like that idea of diagnosing the individual carefully versus, oh, that's this, that's that. Like if you misdiagnose, your treatment's gonna be wrong and you can get sued. We know, that's terrifying to everybody. So kind of behind the whole tech stack, you have to have customization to the individual and then a treatment to the individual. So I see lots of hands up, and again, this is one of those slides we could spend all day on. But I want to propose some of my own ideas here about why I think the people don't simply fix it, and to build off what you're just saying there. So some of them, that they're invisible, is that you actually can't see them. And I think this gets at this response you gave a moment ago, that life kind of goes on, but you don't have a clear quantification of the impact. So whether like you gave the sort of anger management one of like people get angry, like that leaves a scar on people when you blow up at them. Like it's not obvious to you that that person's now scared of you, and it's not obvious to you that that person now trusts you less. But that certainly happened. So I think what's missing is the quantification of the impact of the bias. And if you read an academic paper, that's cool, but like, what about me? Do I have that? So that was the problem that really I wanted to solve for. So one of them, it's invisible, super hard to deal with something that's invisible. The other one is it's automatic. This idea of like stimulus response, boom, I do it immediately, but there's really nothing intermediating stimulus and response. For most people, there's like this reactivity and they just react to what's going on. As was pointed out, this idea of be fearful when others are greedy and greedy when others are fearful. It's like the automaticity of it is where we struggle, and the corollary to that is it feels right. I think that's the toughest one, including anger management, including investment decisions, including being a leader, all of those things. And it's tough to go against your gut because it feels right to get out of the market when there's a drop. It feels right to chase that thing that's going up because regret aversion or FOMO kicks in. And it's tough for people, and it was tough for me to accept this idea that, wait, my gut's actually wrong. And I find that humbling moment, like through studying behavioral economics of all things. It wasn't like I was like at a monastery. I learned this like stuff through behavioral economics, is like your gut can be totally wrong. And if you want to be profitable, you have to learn those things and you have to accept that and be humbled by it. And so those are some of the reasons that's very difficult to fix your biases: their invisibility, automaticity, and the fact that they feel right to do the wrong thing. Here's an example from my like E-Trade account. This is like my play account from graduate school. Like I don't know whether I have the disposition effect by just staring at these positions. Like there's a story about Nvidia I'll show you about in a second. You can all laugh and feel better about any mistake you've ever made after you see my Nvidia story, which has been all over the news. But like we have data, well then, but no firm that I know of, except maybe some of the very, very big, very well-known hedge funds maybe do this, is like track the specific behaviors of people to track their biases. Actually, I'm not even sure even they do. I had a call with one of them, starts with the C, yesterday, and they're very smart people. I'm not sure whether they've identified biases in their data or not. I'm not sure. So let's talk about define, identify, and fix our biases. And the best way to do that is let's look at specific biases that are actual, from the data. So one of them is risk aversion. This is like the classic bias that anyone that's taken economics classes, we start with this idea of risk aversion, that we prefer a sure bet instead of taking a risk. And it's kind of what makes us human. There's nothing inherently wrong with that. It's kind of what is theorized of why our species survived. We are the descendants of people who decided not to go take the risk and figure out what the risky thing. Those who did that were eaten by, saber-toothed tigers or whatever. There's like some sort of developmental psych or evolutionary psych theory that we're the descendants of risk-averse people who survived. So there's sort of some genetic argument for it. But anyway, in practice, what does risk aversion do? It does lots of things. But those who are already in the market is that they sell a winning stock like way too soon and miss out on this like big upside. There's lots of other forms of risk aversion, such as not entering the market at all, or not engaging in anything risky and staying kind of the safe and predictable path. So, Bill, you have your hand up? Shoot.
Yeah, just quickly. I mean, risk aversion, it's all over the place. On the other hand, there's also people who seek out risk, people who go to Vegas, all that. Any ideas as to the characteristics of the two behaviors?
Oh, yes. Actually, so there's like that. There's a lot of research done on that, from like neoclassical economics all the way to like current. There's actually a lot of money going to, specifically you mentioned addiction. There's all of a sudden all these grants available in the US for addiction research. And I've talked to some of these like startups, and I've talked to Wharton about this. But if you look at so there's a utility function called the Savage utility function, paper 1952. And it talks about the difference between like risk seeking and risk aversion depending on the size of the bet. So gambling generally, and I'm not talking about pathological gambling, I'm talking about like small bets, I don't know, under $1,000, whatever it is. Like people have what's actually a convex utility function. And for small bets, like you could think of lottery tickets being similar to Vegas, is like, it's not really lifetime wealth, but I have this like highly risk seeking appetite for these small bets. That's why you see all this gambling, you know, Robinhood, all that stuff. But for big bets, we're like, people are going to back off. So at the small dollar amount, you see a very difference, and then you see it flipping over to what's called the inflection point to concavity, where for bigger bets, people are like much more risk averse. So the same person can be very risk seeking and very risk averse for different dollar amounts in different parts of their life. Like you see skydivers who like, you know, take these big physical risks, are super conservative in other areas of their life. So just because you're risk seeking in one area doesn't mean you'll be that way in all areas. In the research, it's called the DOSPERT. It's a like inventory of testing risk. So I love your point. Again, it's such a deep area. Pathological gambling and addiction are somewhat different from this, where the basically 90+% of pathological gambling is loss chasing, which we'll talk about in just a sec. It's a perfect segue to that. We'll get to that. So for example, risk aversion, as I was mentioning before, as stocks are going up, people will sell, go to cash, you'll get that flat line. And then that light blue line is the basically the upside that they missed out on. So we can now measure that. We can measure those things. The other one is loss aversion. The flip side is that we don't really want to realize a loss. We'd rather delay or avoid it completely. And that has its own consequences, as we talked about, not getting out of a bad trade. So the consequence in practice is like not realizing these paper losses and just thinking that it's somehow going to mean revert just because you don't realize it. So that's an emotional aspect, a behavioral factor. And the graph I put down is if something's going down and people don't get out of that position, they could go down with the ship. And so the counterfactual is people exit a losing position, or they take that capital and they put it into something that has a much better thesis. But behaviorally, people struggle to do the action and they miss out on these big opportunities. Superhuman, happens all the time, but unless we have some language to describe what's going on. And by the way, that's a big part of what we're doing on this talk and in this program in education, is like, let's have the lexicon to describe these things. You might have like a hunch about something, but when someone gives you the term for that, you're like, ah, that's what that is. And so you can use it in a conversation. You can identify it in yourself and others. So this is partly vocabulary. Let me get through this section. Actually, James, do you have a quick question, James? I know I'm like running behind. We have like 15 minutes. I'll make sure we get through everything. Yeah, but, so yeah, go ahead.
No, very, very quick. All I was going to say is, as you mentioned about these biases, as you say, following through on them is difficult. I mean, I'm not sure if others can relate to this, but biases, which I know I have, if you try to kind of almost codify them out so that, you know, you're forced to take the right action because of a predetermined plan, is that part of what you're getting at with this?
So pre-commitment, yes. Like people often
setting rules that are hard coded that kind of it doesn't rely on you taking an action in the moment to have that carry out, because it's already been predetermined when you're in a different frame of mind.
Yeah, like disciplined traders, they don't show the same biases of like discretionary investors. They're like, I'm out at -5, I'm out at +8, like that's it. Like they just have these rules and they don't care. Like they tend to have these things really kind of hard coded, whereas people that are much more discretionary, in like the example of, you know, the nuclear sub, of like when things hit the fan, well, you start to scramble and then you just like, you fall to the biases even worse, versus, you know, when this happens, this is what we do in a crisis, and you have a preparedness plan, you're pre-committed to it, you're not gonna change. So absolutely, making a pre-commitment when things are good or bad, like that's the key, versus just thinking that your default will serve you in the moment, in the heat of the moment. It's not. It's absolutely not.
Yeah, it's being able to put your ego to the side and say, I know I probably won't, and therefore I will do X to stop myself from it, rather than being proud and say, no, I'll be fine. I'll handle it.
Yeah, it's tough. I mean, the cognitive space that you're in a crisis is not the one. Like a hot state processing is very hard to function in. Like we've all been tired, we've all been under stress. Like it's very different cognitive processes when you're under that situation. So let's go, we take risk aversion and loss aversion together. what you get is, as I mentioned, the disposition effect, where we basically sell the winners too soon. We don't realize the losers. I don't see this as much in like more advanced portfolio managers, like people that have been doing this for some time. This isn't as strong, but I see it in a lot of like high net worth people in their data. It shows up very, very clearly, and I'll show you examples. So from a mathematical perspective, you think about 0 being the average cost basis, and then on the left side is the losses. People tend to sell losses much, much steeper or not at all. Whereas the gains, you see that the distribution there is much tighter, so the standard deviation is much lower. They sell the gains much faster, and that's where the missed out gains, because momentum is a real thing and it keeps on outperforming, but they get out too soon because I want the cash, I'm worried it's going to fall back down, and that's where big losses happen, big losses. So let's look at an example of data. So I downloaded the entire congressional data set from the US government. It's actually available, the government provides this. These are members of Congress that are trading actively. It's gotten a lot of news. And so I downloaded the data set. My team and I parsed through all their transactions and said, well, do these people who have inside information and good advice and see things way ahead of all of us, do they have these biases? Let's find out. All right, so disposition effect. So this was Roger Marshall, and we looked at his portfolio is the blue line. And what we did was we did a back test where we recalculated all of his transactions, where we said, let's hold the winners longer and sell the losers faster. So just shifting it over, there's some really cool engineering behind it. But if you look at had he just had less, we dialed down his disposition effect, and the performance difference is massive. Which we saw through a lot of members of Congress. This is just one example. So the disposition effect is real. We backtest it to show you, to make it very clear to you whether you have the bias and what it's cost you. And no one, to my knowledge, has ever done this before. So we can start appreciating the incentives are aligned, that I really want to fix this because I want to go from being, a 22% to, whatever, 100%. Sometimes the delta is massive. It isn't always, by the way. If we had more time, I would show you all of the other areas in which the disposition effect appears. I deleted a bunch of slides before we started just to make sure we cover everything. It also holds up in real estate, selling winning positions soon, hanging on to losing positions longer, same thing. There's one on gambling and goes on and on, but just to stay on topic. And remember that slide about the brain's calculating, making the same decisions in similar ways. You see it across lots of things. So DE, disposition effect, is very real. Somebody mentioned prospect theory, and I'm going to thank you for that so much. I imagine it's been covered in the program to some extent, so I won't spend too much time on it. But the critical point is that in the gain domain, we're risk averse, and that's why we sell too soon. In the loss domain, this is where gambling comes in. When we have a loss, we actually become very risk seeking. We have this big appetite to take risks to get back to the reference point. So if you walked in with $1,000 or $10,000 or $100,000 and you're below that, you're very motivated to take a lot of risks to get back to that starting point. And it's the decisions we make in that state of mind, which we just were sort of alluding to, are not going to be the objective, unbiased decisions. They're going to be, I'm just desperate to get back to where I started. So just by virtue of being very astutely sensitive to that reference point, that's where we get off the rails. And we have to realize that we're chasing a reference point. So in fixing the disposition effect, this is what we provide to clients that we work with, is these are like generic tips that everybody can read. So managing winners takes a different approach than managing losers. And I think the slides will be available, so we won't go through it now just to save on time. But we give people generic tips, but we also show people, well, if you give me your data set or someone advisor or a PM that you're looking to evaluate, we can evaluate them and do a full report on all their biases and show you how optimal or non-optimal they are and how fixable it is. So the next one is loss chasing. So this term you may have heard about. This is pathological gambling, essentially. The flip side of loss chasing is dip buying. So if you're great at buying undervalued assets, that's a great skill. We've seen it in data, it's fantastic. But essentially you're in a losing position. So the current price is below your ACB and you're putting new money into that position. So the consequences in practice is just because I'm in a losing position, I'm going to allocate to this versus, there's a way better idea, but I'm not pulled to that good idea because I'm trying to get back those losses. And once we can have the language around it and the tools to measure whether we're a good dip buyer or a loss chaser, then it just becomes like philosophy. And, oh yeah, we talked about this loss chasing thing, I've learned about it, but it's not really helpful. So if you analyze your data, which we can do, you can say, wow, I'm actually a very good dip buyer. And to add on to that, some people we've seen are very good dip buyers, but they don't do it enough. That they just 5% of the portfolio is dip buying, but the returns are astronomical on that specific sort of sub strategy, if you want to call it that. Whereas some people put a ton of money into these losing positions, and it's 80% of the portfolio, and they're just tanking because of that specific behavior. So we're able to pinpoint the drivers, the attribution of good or bad behaviors. We also call it sunk cost fallacy, revenge trading, averaging down. And sunk cost fallacy was relevant both with NASA and with long-term capital management. And that line is, the price is going down. And what we do is we actually put more money into losing position. And so we actually worsen our state versus putting money into better positions. And then, why we do it. So it feels bad to lose money. We don't have, like was mentioned, the sort of the executive function at the time to have an intervention, which we built. And then somehow reducing your average cost basis. This is like an interesting behavioral thing that I haven't seen written about it, but I've noticed it myself, that it somehow makes you feel better because you think you're erasing the loss by reducing average cost basis. And when you realize you're sort of entranced in this and it's really a bad investment decision, then you're free of it. Until you can identify it, you're always going to be sort of vulnerable to that state. Also, people believe in mean reversion. It's like a common thing that people believe in. It's not always true. We hear it talked about all the time, like it's like from God's mouth. Some things don't mean revert. Some things do, not all things do. So here's an example of loss chasing. This is Chuck Fleischmann looking at his data. So the blue line is his portfolio, and then that orange is just trades that he bought when he was in a losing position. You could see that's a pretty big loss, and you could see it causally drawing down his portfolio. If you're a dip buyer, you actually see it bringing up the portfolio. So we can see it in the data generally pretty easily. The invisible portfolio, this is an idea that I had through making a big mistake, which I'll show you in just a second. This idea that I don't track what I've sold and I don't know what happened. So I don't know the quality of my sell decisions. And basically what it is just let's track whatever you don't even realize, whatever you sold, let's track that for you. And this is a crazy idea through a mistake that I made. And then a paper just came out in the Journal of Finance called Buying Slow and Selling Fast. So again, prospect theory. And it exactly validated this crazy idea I had a few years ago that people put a lot of energy into the buy, they don't put as much energy into the sell. So I feel very validated to go out on a limb before it was published. And so basically what we do is, why do we sell future winners? As we talked about, we become risk averse. We misestimate the value of sell decisions. We always think it's all in the buy. And there has been infrastructure now to help us mitigate that bias, which is what we've done at Profit Wall Street. So the practical consequence, we just make big mistakes. I know we have about 7 minutes, so I want to make sure there's time for some questions. So I'm going to move a bit further. Invisible portfolio. This guy sold a lot of future winners, very, very big delta between those, his invisible portfolio and his actual portfolio. And then, as I mentioned, I had this video a few years ago. I sold Nvidia way too early, and I gave interviews about it. And next thing you know, it's on the news like every couple months. Like this literally just came out yesterday. So I keep getting interviewed and I don't care to talk about my mistakes, but there's like me again. So if you Google my name and Nvidia, you'll see this huge mistake. I just sold it for no reason. I made like 100% profit on it, sold it for no reason. Big mistake. So there are group decision biases. I'll make sure I touch on these. I won't have time to go through all of these papers, but like when we are in a group, we make some decisions that are very different from when we're making decisions individually. And there's a bunch of interesting research. We'll be glad to chat with anybody about this after the fact. I will also say it's not always bad. So there's a paper about reducing the disposition effect as a team versus individuals. So there's actually some good things that happen for making decisions as a group versus individuals. And then private equity, they have their own biases. Just in the interest of time, we'll pass on. And then VC also have their biases. A lot of interesting work done out of Stanford on this. So given everything we've talked about, this is all kind of the bad news. I've given you all the bad news. So the rhetorical question, which I'll answer in the next 5 minutes, is how can you and your team succeed, like despite all these challenges? So that's what we'll go through the next few minutes here. So we want to drive better team outcomes with fintech. So what we have to do is have a group decision process that's de-biased. And what we mean by that is something that's robust, repeatable, and allows you to iteratively improve over time. It's not static. And I have this graphic here going sort of slowly is because it doesn't mean it's fast. And sometimes people don't like that it goes slowly. People don't like that they don't get to be impulsive and kind of shoot from the hip, which is super fun, let's face it. But the processes are what save us, especially in the heat of the moment. And there's a paper in the Journal of Portfolio Management that talks about the very points I was planning to make, is about disaggregated judgment, accountability, argue the opposite, sort of taking the other perspective, taking an outsider's view. Statistical system 2 thinking is like a radically different way of thinking about things versus the, as I said, the shooting from the hip system one perspective, and then sometimes just rotating files that you don't have the endowment effect, meaning that you get very invested in something, that you let somebody else make the decision for a file that you had. I see some funds do that. So group decision process, behavioral fintech. So that's a term, actually, I think I invented it because fintech alone doesn't touch on behavioral. And what we've built is a guided investment process that disaggregates the decision, that allows you to go deeper into each segment of the decision, that portfolio decision analysis, which is what I showed earlier, and I'll show you some examples from my own accounts in a second. Just building human systems that we talked about, sort of the softer aspects, and then AI has to be part of this. Using AI in some ways is actually great. In some ways, I'll show you a fun example where it's not so great. But let's do fintech. Let's do 4,000 years or 3,000 years in about 15 seconds, where initial fintech was like just basic accounting, going back at the very beginning, and then it became sort of more digital, like faster and cheaper. If you look at all the way from the Telegraph all the way to Plaid and Robinhood and Stripe and E-Trade and all that, is like faster and cheaper. But if you make decisions, if we're sort of pre-potentiated to make the wrong decision, the last thing you want to do is make it faster. But that's what it does. So what I believe the next real era that's important is the era of better. And that's what we're calling behavioral fintech and behavioral AI, that facilitates better decisions versus faster decisions. And that's really what Profit Wall Street's about. This was a video, this is AI, this is so funny. I don't know if you can see, this man turns into a woman. The prompt on this was, describe long-term capital management's reaction to the ruble falling. So that was the prompt for OpenAI, and it needs some work because the guy just has a transformation in the middle of it. So AI isn't perfect, as we know, but this was a paper or a graphic that came out a couple of years ago on fintech, but there's no category for behavioral fintech. So I fixed it for him, and there's behavioral fintech, which is a critical piece that pulls it all together. So the investment process that's missing, that's critical to have, is something that I built a few years ago because I realized that we shoot from the hip. We need something to walk us through and deeply think through each component of it. What are my price forecasts? What is my thesis? And on versus kind of thinking of it as this messy whole. Let's break down the decision. And so the question is, does it work? I would be asking that question. We did a randomized control trial of our guided investment tool, and we had a 21% increase in performance, which is much higher than I thought. So I want to make sure these things work versus being just marketing nonsense. Like, we tested it and improved performance significantly. The next piece is identifying bias in your actual data. And what we do is we pull data, whether it's through an API, you deliver the data through a CSV file, compute it, and we show it to you. I'll show you my own data now just to wrap it up. So this is a live account. This is my own account. I screenshotted it versus doing it live. And so that shows loss chasing. So for this particular account, thank God, I'm able to be generating value as a dip buyer. In this account, this is the invisible portfolio. So unfortunately, I sold some very painful future winners, although they're tanking, it makes me feel better. But at some point, I made some mistakes early on in 2022. And then the disposition effect, not a huge delta. Actually, my portfolio is actually beating it for part of it. So I'm proud to show you that, but it's not true on all my accounts. And then coming soon, position weighting and asset selection. And then for PMs, one thing we're developing is for you as a CIO to be able to see how your team is doing and to be able to coach them and identify their biases, so it's super clear where they're strong, where they're weak, and where they can be coached to do a better job from an objective perspective. And that's where transparency is really delivered. So to wrap it all up, we start with NASA. So the good news is they've moved on significantly. The crisis had a big impact organizationally for them. Their next projects did much better. And another example, long-term capital management was absorbed, but Renaissance Technologies is a great example of a firm that does great over time because they constantly reevaluate. 39-40% CAGR since inception, absolutely insane. But it's because of their adaptability and their statistical-based approach and hiring a lot of physicists. So what determines your team's performance was sort of the last question I had for discussion. I know we're at time, so I will either end there, Molly, or if you have a few minutes for discussion, I still have a few minutes.
Yeah, we've got about 3 minutes. I got about 3 minutes before we need to wrap. So are there burning questions out there that you desperately want answered before we call it a day? I think the number of hands that were up throughout the session is very indicative of how much folks enjoyed this, though. So Actually, I'm going to go to Rit, our success coach, and then Zaid, I will come to you, my friend. So Rit, what do you have for us?
Hey, Amos, thank you very much for a great presentation. I have a question a little bit about some of these behavioral biases. Like, let's say, for example, we go back to disposition effect, right? That people tend to hold on to loser and sell the winner. In the moment, it doesn't seem that it's all driven by behavior or some psychological impact, though. It seems like, there's bad news came out, and you're deciding, is it because of, are people actually oversold it? In which case, that's behavioral driven, or is it really bad news that are really driving the stock down? So in some cases, I find it a little bit difficult to separate whether am I selling this should I be selling this because really bad news is coming out, or am I selling it because I'm overreacting? How do you think about sort of kind of differentiating all these, components?
The data tells the story at the end of the day. Like, one of the like, bad news comes out all the time, whether it's macro news or company specific news. The ability to stay in a position despite some contradictory news or something like that is one of the skills that's important. It's like, well, that news came out, but my thesis is actually not even about that. My thesis is about blah, 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 blah. The data for your specific account will demonstrate whether you reacted to that bad news and prematurely sold a winner. There are people, and there's a portfolio manager we're working with right now who's actually at Columbia. He's like a savant at being able to differentiate between bad news where he sells and bad news where he doesn't sell, because his active management is like off the charts. And it's your ability to differentiate whether that bad news is materially relevant and the future price will be negative or not. So it's all in the data, and I'm happy to, by the way, look at your data and give you a clear answer about whether you're able to disentangle those two things.
Real quick, so the current high volatility of market environment is tailor-made to accentuate prospect theory, just to kind of put that in perspective. But here's a question real quick. If I have to give advice to a retail client how to fix biases, what would be the shortest answer for that?
So up until now, you had to manually hold their hand and talk to them, and then call you. Is like very, very manual. What we're trying to do, and actually working with RIAs who are like customer facing, is we're trying to give them this technology to put it in their hands to be able to diagnose, because some people are actually really good at it. But what most retail clients do is they panic sell. So exactly this point, Rit, about bad news, oh my God, freak out. Well, what we do is we show them what happens when people sell whenever there's some sort of volatility or some sort of bad news. And it's classic, like there's this light dip and they go to cash, but then the S&P goes on. So you can do that with an individual. You can have like the sort of ready-made answer, but it also depends on what's in their portfolio. For example, if they're like holding a bunch of single names or even like bad quality speculative assets versus like an ETF that historically has always bounced back, you have to know whether you're dealing with somebody whose composition is a bunch of speculative assets that might actually go to zero, or you're dealing with high quality, well-diversified ETFs that the right answer is just hang on. So I think there's a little bit of pre-qualification about what type of customer it is, and then what kind of assets they hold and what kind of approach they need. We're trying to help at Profit Wall Street to help advisors deal with those clients and show them the real facts about panic selling, which is the term that we're kind of dancing around right now. I hope that helps, but some pre-qualification. Yeah, no, thank you.
It does. Thanks, Amos. Appreciate it. Thank you.
Thank you.
Wonderful. Thank you so much. Again, the number of hands that were up, the amount of comments that are in the chat. Rick just said, this is fantastic. So thank you. And then Amos, thank you. Molly, thank you too from Alexander. You guys are so welcome. You're also so welcome. Amos, thank you for your time. We really appreciate it. The learners appreciate it. Yes, David says thank you as well. So take a moment to look at those kudos in the chat. And hopefully we'll see you again soon.